Welcome to today's edition of Beat the Street on IG Live. It's Friday the 20th of October. Let's take a look at the headlines as we take you through to the Wall Street Open in 1 hour's time. Jerome Powell out yesterday's comments on monetary policy lifting US 10-year Treasury yield above 5%, and that's putting some pressure on equity markets. They're poised to open lower in the session in today's trade. We'll take a look at the details in the next couple of minutes. Meanwhile, US earnings continue. We've seen third quarter numbers out from American Express. The stock initially lifting, but is now on the way down. 24 hours on the IG platform after earnings beat estimates, helped by resilient spending from wealthy customers. And the precious metal, gold, on the way up, set for a second straight week of strong gains. We'll take a look at what's behind it, where it's going, and where the likely endpoint could well be in this technical move we've got at the moment for the precious metal. Welcome. As I said, this is Beat the Street. We're taking you through to the open on the trading day today. What I want to do is to begin with volatility, because we've seen this peak up to 6-month highs. And this indicates that people are less likely or less appreciative of risk. And as a result of that, we've seen people coming out of some of the risk assets in the markets. In just a couple of minutes' time, we'll be taking a look into some more detail with our guest in the session in today's program, John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management. We'll be with him in a couple of minutes' time talking about these markets. With this directional trade we've got at the moment, with volatility peaking up, this indicates a potentially lower start to the trading day on Wall Street. These are 24-hour markets at the moment. We've got the Dow at 33,297. We're down below the close on the cash session last night, indicating, as I said, a lower open to the start of today's trading session. S&P 500, same sort of thing. We are on the way down, I think, to this total retracement down to 4,200. We're currently trading at 4,261, again, lower than we were at the close of the cash session last night. So again, it's a lower start to the trading day. On the tech-heavy NASDAQ as well, again, same sort of thing. We're peaking now down at two almost 3-week lows on the Nasdaq at 14,715. It's been a really big week in terms of some of the earnings that we have seen. But before we get to the earnings, let's take a look into some more detail about what happened yesterday, which steered the markets lower, with the Federal Reserve Chairman Jerome Powell acknowledging signs of cooling inflation, but said yesterday that the central bank would be resolute in its commitment to its 2% mandate. As Powell spoke, futures markets traders erased any possibility of a rate hike in November, but gave the impression that rates may stay higher for longer. Now, this pushed the 10-year Treasury yield to breach the 5% mark for the first time since 2007. I want to take a quick look at what's happening with the dollar. This is the dollar basket. Now, I've got this Andrews pitchfork on here, which is what I wanted to follow up on. We've seen this big move up that we've seen since the lows that we had for the dollar basket back on the 18th of July. And we've been long on all this market all the way up to this point up here, the 106.98 level, which is where we take this pitchfork from. You can see we're in the lower quadrant at the moment, or one of the lower quadrants. We are up in today's session, currently trading at 105.96. And broadly speaking, this little bit of a move down we've seen recently is just a small retracement, what is otherwise a market that continues to move on the way up. Now, let's take a look at some of these earnings out today. We've seen an about turn for American Express, but it did come through with some pretty good numbers. The third quarter figures out today. It's sixth consecutive quarter of record revenue, up 13% from this time last year at 15.38 billion. Third quarter earnings per share rising 34% to $3.30 against expectations of $2.96. The increase was primarily driven by higher average loan volumes and increased card member spending. Consolidated expenses were $11 billion, and that was up 7% from this time last year. The increase primarily reflecting higher customer engagement costs. Now, American Express is one of the stocks that trades all sessions on the IG platform. What I want to do is to take this apart and take a look at 15-minute candles, and you can see clearly here when the stock reported, or when the company reported these numbers, we saw a peak out up at $154. We're currently trading at 149.25. Now, the market has pulled back from the highs. There's concerns about the longer-term outlook, and we've been seeing this. As I said yesterday, Jerome Powell talking about the cooling growth. He said growth will have to ease in order to bring back inflation. And I think this is the longer-term picture that many stock traders are looking for, to find a bottom in these markets. And you can see quite clearly here on the day chart that we're down and expecting a lower open to the start of today's trade for American Express. The oilfield services company SLB, formerly called Schlumberger, third quarter earnings out today, beating estimates for quarterly profit, resilient offshore and overseas drilling activity boosting demand for its equipment. Net income, excluding items, 78 cents a share compared with the average analyst estimate of 77. Higher oil prices also encouraging drillers after Russia and Saudi Arabia extended output cuts. This is not a stock that trades all sessions, but it is worth looking at this potentially on the way up at the start of today's trade. Also watching out for Hewlett-Packard Enterprise at the open. After the closing bell last night, the company fired a warning shot across the bows, unveiling its outlook for 2024. The company said adjusted earnings per share for 2024 is expected at $1.82 to $2.02, well below the estimate originally of $2.14 per share. The company said it's shifting its portfolio to higher growth, higher margin businesses with an aim to increase its long-term profitability potential. Another company reporting just before the numbers come out in a week or two's time, I think it is, for the latest quarter. As I said, it's just firing a shot across the bows as to how the company sees the full year developing. Now, let's get up to speed now with some more commentary around the market open today, but also the longer-term picture with John Stoltzfus. He's the Chief Investment Strategist, Oppenheimer Asset Management. Joining us on the line now from New York. John, welcome. Thanks indeed. And your patience for waiting in the wings, just going through some of the companies worth watching today. I want to get your thoughts on the big picture, though, first of all. Jerome Powell yesterday sending yields up, markets taking umbrage on the way down. How do you feel about the investment opportunity at the moment, given the current environment?
Well, great to be on the show, Jeremy. Thanks for having me. We'd have to say, you know, when it comes to Jerome Powell, we think it's very clear to us that he is determined not to be remembered as Arthur Burns, who was a Fed chair who many years ago failed to address inflation properly. And I think all he's saying is that the Fed will remain vigilant And I think he said that all along, that it will take action against untoward levels of inflation, which threaten the intermediate and long-term growth of the U.S. And with that in mind, we think the equity market seems to be overly sensitive and thinking that the Fed will likely be very clear and announce that it is going to stop raising rates, while in this case we would say rates will likely remain higher for longer, but we don't think they're necessarily going to move up much higher over the course of the next 12 months.
It's interesting, isn't it? You mentioned Arthur Burns. Going back in my mind, he was the Fed chair, I think, in the 70s, wasn't he? When, of course, there was this oil crisis. And we are facing a very difficult and tight oil market at the moment. How do you feel about oil and the prospects, bearing in mind the heightened geopolitical tensions?
Well, I think related to oil, the problem is it's not so much that there is not availability of oil. The problem is you've got OPEC plus essentially limiting production or keeping a cap on production. And in the U.S., you've had an administration that was unfriendly to the fossil fuel energy area of U.S. production, which originally cut production, then it raised production, now it's trimmed production, and now it looks like with the acquisitions that are occurring, there's a realization, and I think across the board, including that of the administration, that the bridge that requires fossil fuel that leads eventually to greater dependence on alternative energy, once it has the scale to deliver the goods at the street level of charging cars and dealing with the pollution that will be created by all these batteries that needed to be mined for by the metals needed. We think it's a better time for energy. So we think that energy has a calling here. We're looking for energy to trade between, believe it or not, between the range that it has traded in between, around $74 or so to as high as maybe 90, 95 in terms of WTI. But we think that it'll remain in a band because the underlying story is there's plenty of oil and plenty of technology to bring it out of the ground, at least for the near term. The longer story looks like we may be, when we talk to energy people, that we're getting, historically close to peak production once we get back to a raised level of production.
Yeah, let's bring up a chart of WTI. You mentioned that, and in fact, on my chart here, in fact, recently back on the 20th of September, that market peaking out at 94.30, not too far away from your your target price at the moment. But at these levels, it continues to fuel inflation, doesn't it? Though, doesn't it just give this extra sort of frisson, I suppose, in the markets? It means that inflation is likely at least to stay where it is. It's certainly not going to come down, is it? So what, rates higher for longer? What's your thought in terms of inflation and the outlook and the oil price?
Well, we've got to say that it certainly is a feed into inflation. It's felt by the consumer and by business every day whenever they fill their tanks, whether it's for trucks or lorries or automobiles. And with that, the political pressure to favor fossil fuel and hybrids versus pure alternative vehicles is likely going to grow. And we think overall inflation is stickier. The Fed recognizes it. And that's why the Fed, even though it is likely at the next FOMC meeting not to raise rates, will hold in abeyance for the moment. But there's a chance that before the end of the year, we will have one more hike, and likely next year, another hike at some point. But then we think we get to a long pause into the second half of the year that will likely result sometime in the fourth quarter with at least one cut.
Let me go back, if I can, take in the S&P 500. Let's bring up a chart of that. I had it up earlier, just showing how the markets are likely to open. What are your thoughts in terms of where we are? Technically, I'm looking for it to hit the 4,200 level, which were the lows we had in the last couple of weeks. And then thereafter, I'm just going to wait for the markets to sort of regroup and work out where they go next. But what are your thoughts going into the back end of the year from where we are?
Well, I am a fundamental strategist. Ari Wald is our technical strategist. But the curious thing is, Ari and I are very much, although we don't converse much, we listen to each other and watch what we've written. Just because our travel schedules are pretty intense and demands on our time. But we come out about the same end. Effectively, we're looking for higher stock prices. We think we are bottoming out at this point. And the story looks to us driven by innovation that is not only positive for technology and communication services, but is good for industrials, for healthcare, for energy, all the way through the consumer staples, consumer discretionary. The technology story is your driver here. And we think that the positive effects to all 11 sectors overall going forward, the market's a discount mechanism. We think the overall trend will be not only a rally, but a rally that will gather strength likely before the end of this year into next year.
Do you have a price target?
Yeah, our price target for this year is for the S&P 500 by year end is 4,900. It initially was 4,400, which we put back in last December. At that time, it was one of the highest, if not the highest on the street. In June or July, when that target was exceeded, when the market closed above 4,400, at that point, we raised it thinking we could go 6% higher to the end of the year based on the momentum we were seeing and allowing for the thought that we might have a rough fall from a traditional seasonality. However, with the outbreak of hostilities in the Middle East, with the Hamas's attack on Israel and the threats to oil and all, we do think that enthusiasm may be curbed and somewhat. So we'll have to look at it, but we'll hold our target for 4,900 right now because we still have, we still have November and December and basically the last 10 days of October here to see what's going. The overall effect so far has been to contain or constrain any rally that shows up. But we think that the market is going to get the idea the Fed is not trying to kill the economy. It's just trying to put untoward levels of inflation in check. And we think it's positive for equities.
Yeah, just briefly, one final question. What's your view globally on markets over here in Europe, on this side of the Atlantic, emerging markets and the Asia-Pacific region? Do you have any favorites or do you have areas to avoid at the moment?
Well, right now, we think it's important to participate internationally for U.S. investors on prospects that as things improve and stabilize, that the dollar will come down off of its high throne. And at that point, benefit U.S. investors' entry into both developed and international emerging markets. But our thought right now, near term, is overweight the U.S. While maintaining meaningful exposure to Europe and the emerging markets. We're not looking for the end of globalization, but a re-globalization via the diversification away from a one country-centric supply chain, which is really very actively happening now. And in the process of that, it should benefit many emerging market countries that already is beginning to, and also developed international countries, as the world remains very prone to getting the best deal for their consumers and businesses, whether it's for quality or what's offered or pricing. Globalization is intact and technology remains a key driver.
Okay, look, John, we've got to leave it there, but thank you so much indeed for joining us. It's been a pleasure. And we'll feed off some of those quotes and that 4,900 level for the S&P for a few days to come. It's a pleasure. Have a good weekend. Thank you.
Thank you.
That's John Stoltzfus. He's Chief Investment Strategist at Oppenheimer Asset Management, talking there about his thoughts. Just want to quickly catch up on a couple of other areas of the market. After we say goodbye to him, I just wanted to go back to this oil market because one other thing we've got today is the Baker Hughes rig count. Just want to quickly remind ourselves of what happened last week. This is the oil price we were just talking about, 89.27 for WTI, slightly better off on Brent. Let me just wind the clock back to last week, because I think we've got a chart here, an animation on the graphic showing you what happened to the Baker Hughes rig count last week. Rigs in operation climbed 3 to 622. This means a little bit more oil coming onto the market. Crude oil rigs rising to 501, 4 more than the prior reading. And that's going to be an interesting number to watch this afternoon to see whether or not any more rigs come online because of this rise in the price of oil. One final area of the market I just want to catch up on as well is what's happening with gold. 1979, almost done technically on this little pennant pattern I've been drawing here, and I've been following on the early morning call. This means we're now not too far away, just $21 away from the 2000 level, which would then take us up to these levels not seen since the 16th of May this year. So gold looking good going into the back end of the week. Certainly best 2 weeks we've seen for gold this year. That is an absolute certainty. That's it. We are back. Well, I'm back at 4 o'clock this afternoon with Tony Batista from Tasty Live. Taking a look at some of the trades to watch out for next week. And then I'm back on Monday morning at 7:30. Hope you can join me then for Europe's early morning call. Have a good weekend.